here today in the studio with Ryan Irvine of Keystone Financial. Ryan, thanks again for joining us.
It's great to be back.
Well, a couple picks that you want to talk about today that are decidedly untrendy.
Yes,
but
we'd
you know
love to be
when
untrendy.
it's exactly, but when it's up almost 400% in 2018, that's not a bad thing necessarily. Expel Inc. trades on the venture exchange DAP.
DAP.U. So .U means
yeah.
it trades in US dollars, so it's kind of unique in that respect. Boring business. What do? They have automotive film. That's what they sell essentially. That and window tinting. So you know that film you put on a car to prevent those annoying scratches and dings you get from rock chips or rocks filling up in that chip on your automobile. Tremendous growth in the underlying business. That's what's driven the results. So when we saw this company originally, when we've been monitoring it for 4 years, we always liked the business. It wasn't effectively priced, and we didn't like the margins. Now margins have picked up tremendously over the past 12 months. That's what's driven the stock. In the last quarter, they had 65% growth in revenues to just 30 million in that range. 8 cents in earnings, up from around 2 cents in the same period last year, so a four-fold increase. That's driving the stock price going forward. We love to see a company that is driven by underlying earnings because then we can value it. So you know, it came out with Q1 earnings this year. It was trading about the $1.50 range, and it jumped to just under $3. Now we recommended buying it again at that point because it was actually, now this is a hard concept to go into, but it was actually cheaper on an earnings per share basis, cash flow going forward basis, having doubled because of how tremendously profitable that quarter was. So we think it's a good business. We think there's growth going forward. It's trading around the $6 range, in that range. I think it still offers value here. Obviously, it's had a tremendous run already this year. But you know, if we just give it a conservative 15 times multiple of what we think in next year's earnings will be, we think there's an $8 valuation there. So that's still a significant lift from where you are right now.
And what about Sangoma Technologies? What is it about that company? Again, trades on the TSXV, STC, stock symbol.
It's a unified communications company. They just made a transformational type acquisition of a company called Digium, which owns the Asterix open source platform. Now, what we like is the growth going forward. This company has done smart acquisitions. It's difficult to do a growth by acquisition story, but this company has done it accretively over time. They made this their biggest acquisition just in the last several months. Now, going forward next year, we expect a 50% lift in terms of EBITDA, up to the $9 to $10 million range. So that's a tremendous growth in terms of EBITDA. It'll hit $100 million in revenues this year. So it's a sleepy little company that's going to do $100 million in revenue, and it's trading at relatively reasonable valuations. We think right now it's probably worth $1.60, and it's trading $1.20 in that range. So again, that's a good lift from here. And if management can continue to grow operations, they think we're going to see an uptick in margins the following year. If it can do that, then the company's positioned well. It's growth at a reasonable price, and we'll hold it. We've been holding it for 2 years now, and we'll continue to hold it going forward.
Okay. Well, Ryan, as we wrap up here, what's on your radar for 2019, going into 2019? What should we look at?
Yeah, I mean, I would, we're always looking at every company in Canada, looking for great value, and really, we don't have a theme right now that we're looking at. We do, if there is going to be a downturn, we've been told for about 5 years there's probably a downturn coming. There always is a downturn coming. We'd like to own companies that, they say you could go to cash. We like to go to companies with cash or net cash positions on their balance sheet, because those type of companies, if you have a downturn, they can go out there and buy assets when they come on sale. So that's why a lot of the companies that we look at have strong net cash positions, limited to no debt, particularly within the small cap area. So we'd be looking to buy companies that are cash rich, and we have a report coming out on that just in the next 3 weeks. So it's our cash rich, profitable small cap report. Profiles about 70 companies in Canada that have net cash positions, smaller companies, all profitable, and we make 2 or 3 new recommendations out of that. That's what we'll focus on going forward. If there is a downturn, we want to own businesses that have great balance sheets that can withstand, but not only withstand a crisis or any type of downturn, not necessarily a crisis, but a downturn, but they can profit from it by buying businesses that are on sale.
Okay. Well, there you go. Another few picks from Ryan Irvine. Ryan, thanks. It's always a pleasure having you here.
Thank you.